Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to degree of operating leverage, degree of financial leverage, and combined leverage. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. We have the information on the left-hand side. We're going to put that into the blue area into our worksheet on the right-hand side, calculating the degree of operating leverage, degree of financial leverage, degree of combined leverage, and the break-even point in units. We'll do this for a couple different scenarios so we can see what the effect is on these calculations, these leverage calculations. Now, when you think about leverage, you're thinking about something that's going to be kind of a balance between risk and reward. And most people, when they think about leverage, you're thinking about the debt leverage, meaning the calculation of how much financing you have and how leveraged the company is and what will be the effect of that. We also want to deal with the degree of operating leverage, which is going to have to deal with leverage with relation to fixed costs and variable costs, the relationship between fixed and variable costs. So we're going to go through the calculations here, and again, we'll take a look at some changes in order to see what those calculations will do with some differences in the income statement. So we got the income statement up top. This is in a contribution margin type format. Now note, when we go over some of these calculations, there's a couple different ways we can think about how to get to these numbers, how to get to the degree of operating leverage, the degree of financial leverage, and it depends in part with the kind of information that we have in order to do so. So we'll take a look at later presentations, some different ways to do this, including possibly the percent change in operating leverage and the percent change in sales. Why would you have these different types of formats that you can, get to these numbers? Well, if you're internal to the company, you're going to have things such as you can rework the income statement in the format of a contribution margin type of income statement as opposed to a standard type of income statement. If you're external to the company and you're looking at, finance decisions like purchasing type of decisions, you're going to have the financial statements for the company, and you may not as easily be able to reconstruct those financial statements in the format of a contribution margin income statement. Therefore, it might be easier to do some calculations using a different method to try to get to the same result, to get to the same type of analysis. So when you're internal to the company, then it's easier than to reformat basically your income statement to an income statement that can be used to break out some of these analysis, that being the income statement in a contribution margin type of format. So that's what we're going to focus in up here on, basically this kind of formula up top. And then again, we'll talk about this one at a later time. But again, we're getting to a similar type of bottom line numbers here. So we got a contribution margin format income statement, sales, unit price. That gives us our total sales minus not the cost of goods sold, which would be normal financial income statement, but variable costs calculated as units times the unit cost, unit variable costs. That gives us the total variable costs, and the sales minus the variable costs would give us the contribution margin, and then we're going to subtract out the fixed costs, and that'll give us the earnings before taxes, that being the sales minus the variable cost, which would be the contribution margin if we added that, and then the fixed costs. And then we have the interest. That'll give us the earning before taxes, then the income taxes, earnings after taxes. All right, degree of operating leverage, we're going to be calculating using this formula up top. Again, a couple different ways that you could think about how to calculate it. Contribution margin over the operating income. And you can think about that, okay, contribution margin over operating income. Contribution margin up top, so we have to understand what the contribution margin is, which is going to be the sales minus the variable cost, but you can also calculate it as the price per unit minus the variable cost per unit times the number of units. So this formula up top here will give us basically the contribution margin, total contribution margin, right? Not the contribution margin per unit. And then bottom line operating income can otherwise typically be thought of as the contribution margin minus the fixed costs. So here's our contribution margin minus the fixed costs. In other words, the item in our income statements before we have been considering the interest and the income taxes. So in other words, earnings before interest and taxes. All right, so that's going to be our formula, which you can also kind of break down. You can see that contribution margin minus the fixed costs in this format, which this first portion of it would then be the same as this up top. That would be basically the contribution margin minus the fixed costs. Okay, So now, and then the second component is like an alternative method that we can basically use. So we're going to be using this method up top. I would memorize it as contribution margin over contribution margin minus the fixed cost. That's how I would think about it. But then you have to understand how to calculate the contribution margin, which you can do in a few different ways. One way is using this formula here. All right, so let's do this. We're going to break this out in like a tax kind of format. So I think it's useful for us to do this step by step in like a vertical format. Although, of course, you can plug this just simply into the formula as well and do the algebra on it. I think it's useful to break it out in this format to understand it. So we'll break this out into like a tax return type of format. Let's calculate the top portion, which is the contribution margin. So I want to get to the contribution margin top format of the formula. So that's going to be the units. That's what X is here. So I'm going to say we have the units sold. Units sold is what X is. And it looks like the units sold was the 26,000 units sold. Now, by the way, just note that I'm going to go by this formula up top, because they want the price minus the variable cost times the units sold. But you could just calculate the contribution margin as, if we already have the income statement, total sales minus total variable costs, and we would get the contribution margin. But I'm going to get to that number the way they have it in the formula here, which is going to be the units sold X times the price minus the variable costs, and we call that the contribution margin per unit. So I'm going to do another little subtotal here for the contribution margin per unit, which is the price minus the variable cost. So we're going to say sales price is going to be equal to the 72, and then the variable costs per unit is going to be the 36. Subtracting those out, let's put an underline here, home tab, font group, underline. That's going to give us the contribution margin per unit. And that's going to be equal to the 72 minus the 36, which is 36. And that's going to give us then the total, which will be the total contribution margin. So the total contribution margin then is going to be equal to the 26 times the 36, giving us that 936, which again we could have gotten by taking the sales minus the total variable costs here. Let's put an underline. That's an underline here. So now this outer column represents the top half of our formula here. And so let's do some formatting on it. I'm going to format these three. I'm going to go to the home tab, alignment, increase the indenting. Then there's a colon here, so I'm going to format these three, which is going to be home tab, alignment, increase the indenting. And then we've got the contribution margin here. Let's go ahead and indent that. Let's just put that indented here. So there's the contribution margin. Now we're on the second half, which is going to be I would call it the contribution margin minus the fixed costs that we're going to calculate. So we're going to say, all right, contribution margin minus fixed costs. The second part of our formula, I'm going to put the total in the outer column in our little tax format formula. And that's going to be then the contribution margin, which we already figured out now. That's going to be equal to this. We know the contribution margin. I'm going to put that in the middle column, equals this number. We just calculated that. Then we're going to subtract out the fixed costs, which are given over here. Fixed costs are going to be equal to the 460,000. So that gives us the contribution margin minus the fixed costs. And I'm going to subtract the little colons. And then I'll select these three. Home tab, alignment, increase the indenting. Home tab, alignment, increase the indenting. I'm going to subtract these out. This equals the 936 minus the 460. We'll put an underline here. Home tab, font group, and underline. So there we have the bottom part of our formula. Now we could just divide these two out. The two numbers in the outer side here is going to be equal to the 936,000 divided by the 476,000. That's going to give us, let's do that one more time. This equals the 936 divided by the 476 is going to give us 2. We're going to add some decimals. Home tab, numbers, add decimals. We can keep going here, but we're going to keep it at the 1.97. That's going to be our degree of operating leverage. there, and we could put a double underline here, going to the home tab font group and double underline. So that's going to give us an idea of a measure of basically our relationship between the fixed and variable costs. Now notice if you have more fixed costs, then you can think of us having more kind of risk. The more fixed costs we have, kind of like the more risks we have, because that means we have to pay the fixed costs no matter what, whether the sales go up or down. Like you can think about it as if you have a hotel that has a large fixed cost for the building, the depreciation of the cost of the building itself. Then, you know, if you have the hotel is packed, then that's great. You know, you're utilizing the cost. But if the hotel goes down and you don't have a lot of vacancies, well, then you still have the fixed costs, you know, that is related to the hotel itself, rather than the variable cost, which would be like the maintenance, because that's usually a small portion of the total cost for something like a hotel. And there's a nice little calculation you can see to think about this. We're going to say, well, what that'll tell us then, we could say, well, what if there's an increase in sales of 10%? If there's an increase in sales of 10%, we can see based on this number what the increase in the earnings before interest and taxes, in other words, this number, or the operating income, otherwise often known as, will be. So we could do that by saying this is going to be equal to the 1.97 times the 10% increase. So if we say there's an increase in sales, I'm going to format this now, home tab font group numbers, there's going to be a 20% increase in the increase in earnings before interest and taxes. Now, let's go ahead and then prove that. We're going to say, okay, what does that mean? It means that if we take the earnings before interest and taxes, I'm going to take this number here, earnings before interest and taxes, and then I'm going to increase it by the 20%. So I'm going to say, all right, well, what if we take this number times, now I got to multiply it times 120%, or 1 plus the 20%, brackets, 1 plus 20%, 1 plus that number, 120%, means that we're going to have the earnings would go up to the 569.6. So if there was a 10% increase in sales here, then the earnings before taxes and interest, our operating income, would go up to that 569.6. So now we're going to prove that, meaning we're going to take this same income statement here and we're going to increase the unit sales by 10%, which will increase the sales number by the 10%. So we're going to say, all right, if the units that we sold are increasing then by the 10%, we're going to say this is going to be equal to the units we had up top. And I'm going to say times, and then I'm going to say brackets. We're going to say 1 plus this 10% increase. We're going to increase it by 10% again. And so now we're going to sell units of 28.6. So that's going to increase the sales by the 10%. Now the variable costs vary in proportion. So we're going to have the same increase, of course, in the units we have down here. So we have the variable costs then increasing to this number based on the same units sales. The fixed costs, however, are now remaining the same. So you can see now that we had an increase in sales. What's going to be the fixed costs? We're going to say remain the same. What's the effect on the earnings before taxes? And we'll say then let's do the calculation here. So we're going to do this calculation by saying, all right, we'll take the difference, which will be this number, the change. Let's put brackets around it. Brackets, the change, or the new number minus the prior number, which is the earnings before taxes and interest here, closing up the brackets, divided by the prior number. And that's going to be our 20%. Or in other words, we could take the current number, which is going to be this, and where the prior number was this, the change is going to be this minus this. And the way we calculate an increase, let's pull these up. I'm going to pull these all up to here. The way we calculate an increase is going to be we take the change divided by the prior period, which is this number. And then I'm going to make that a percent. Home tab, numbers, make that a percent. And there's our 20%. So this is the new number, prior number, change, and then this is the increase. Just another way we can see that calculated, just to make that clear. Okay, so that's kind of a nice little property. Let's move this one up one. Okay, so that's a nice little property to have. Now let's move on. We're going to move on down to scenario B here, another income statement. We're going to compare this one up to the beginning, the first A. It's like A1, I guess. This item up top, where we had the earnings at the 476,000. Earnings at 476,000. Let's move on down to scenario B here, where we still have the earnings before interest and taxes at the 476,000. However, there's a change now between the variable costs. The variable costs here have now gone down. See if we go up top, they've gone down, and the fixed costs now are going up. So we're talking about this firm now has more fixed costs, even though their earnings before interest and taxes is going to be the same. So they're more kind of leveraged in terms of operating leverage because they have higher fixed costs, even though their earnings before interest and taxes or operating income is the same. So let's do this calculation for the degree of operating leverage for this firm and see what we come out to, and then we'll take a look at the changes for them. So once again, we're going to do that the same formula, and we can copy this from the formula up top. Let's go ahead and do that. What I'm going to do is I'm going to say this will be equal to, I'm going to do it this way and then say equal to the contribution margin. I'm going to say enter, and then I'm going to copy the formula down. So I'm going to say enter, and then I'm going to take that first tab, put my cursor on the fill handle, and drag it all the way down so that now we have a formula. Now I'd like to format it. So I want to format the whole thing. So I'm going to go back up top, going to put my cursor on this whole thing, and I want to format it the same way. Therefore, I'm going to go to the Home tab, Clipboard, Format Painter, and then scroll on down, and then I'm just going to click the first cell here, and that'll paintbrush the entire thing. There's the Format Painter painting that in. So let's go through this calculation again. Once again, we want the contribution margin over the contribution margin minus the fixed costs. So we're going to say, let's pick up the units sold. I'm going to put this in the middle column. The unit sales are going to be the 26. Then we're going to look at the contribution margin per unit, which is the sales price at the 72, which is the same, but now the variable cost is less at the 20. Therefore, the unit contribution margin, 72 minus the 20, is going to be 52 now. And so now we're going to be picking up, this will be equal to the total contribution margin, units sold, minus, or times, it's going to be the units sold times the contribution margin per unit. That gives us the 1,352,000. Note, we could have also calculated that as taking the total sales minus the total variable costs, giving us the contribution margin, the total contribution margin. The bottom part of the formula was the contribution margin minus fixed costs. We've already calculated the contribution margin, so that's the same number. Subtracting out the fixed costs now, that's going to be now this number, which has now changed, increased compared to the first scenario we had. Subtracting these out then, there we have it. Now we're going to divide this out. We're going to say the 1,352,000 divided by the contribution margin minus the fixed costs gives us the 284. Now let's do our same kind of thing and say, okay, now I know this one is more highly, has a higher operating leverage because it's a 2.84 versus our first scenario up top, which was at the 1.97. And the net, the income before the operating income was the same. That's because this one has more operating leverage, meaning its fixed costs are greater than its variable costs. If I was to then multiply this out and say, well, what would happen if there was a 10% increase in sales? Then we could say, all right, if there's a 10% increase in sales, the 2.84 times the 10% increase, let's make this a percent, Home tab font or numbers percent, 28% increase now in the earnings or the operating profit. versus before we had the 20%. So you can see if times are good, in other words, just like with financial leverage, then the increase could compound and be good, right? It could increase our earnings. However, if there was a 10% loss, let's see that there was a negative 10%, of course, then we would have a 28% decline versus if there was a decline here, it would only be a negative 20%. That's why there's more risk, right? So the more leverage there is, then we have the more risk, potential upside, profit, and then the downside would be a more of a problem. So increases would be greater if you're more leveraged and times are good. Then it's going to multiply the leverage will multiply the benefit that you'll get oftentimes. But when the times go down, then it could multiply the extent of the losses you'll have. So then let's think about, all right, if I say there's a 20% increase, then what's the estimated earnings before interest and taxes? We're going to say that it's going to be equal to, we had our number here, here's the earnings, and then we're going to say this times 1 plus the 10% brackets, we're going to say this times 1 plus the 28%, that's what we think is going to be the increase, and that's going to be the 6112. So if there's a 10% increase in sales, we think that the estimated earnings before interest and taxes will go to the 611,200 as opposed to this 10% increasing up here, which went only up to the 569.6, even though we started at the same point. Let's prove that now. So we could say, all right, let's just increase our income statement the same way. So this is the same income statement we had up top, but now we're going to be increasing this number, the units we sold, by 10%. So I'm going to say, all right, let's say we just increase this times, I'm going to say 1 plus the 10%. So 110% increasing by 10%. And there we have our increase. And I'm just going to say this will increase the variable costs in the same way. That's why they're variable. Fixed costs then will remain the same. So there's no change to the fixed costs. So what's going to happen then, we're going to have we can calculate this. I'll calculate this a couple different ways then. An increase in the earnings before taxes. And let's think about it first. Using this equation, we're going to say, all right, the new number, the earnings before interest and taxes is that. The prior number, earnings before interest and taxes, was that. The change is going to be this minus that. That's going to be, let's underline that, home tab, font group, and underline that. And then the increase is going to be equal to the change divided by the prior number. That's how you have a percentage increase. So we're going to say this is going to go to the home tab, numbers, make that a percent, about 28%. So there's our 28%. If I wanted to do that with just one formula, I'd say this would be equal to the new number minus the prior number divided by brackets divided by the prior number. So just so we could see that in one formula. So you can see here, and we can kind of prove what that will do as the leverage basically increases, as this operating leverage increases. Again, we have the potential gains could be amplified if there's good benefit in the market, if the market goes up, if sales go up. However, if the sales go down, again, we'll have an amplified decline. So leverage comes with possible benefits and, of course, with more risk. So the question, just like with financial leverage, is balancing between the risk and the potential increase due to that. Okay, so next time we're going to go back and we'll do a similar process for the degree of financial leverage, and then we'll look at the degree of combined leverage and continue on with this problem.